Welcome back to Invest Avenue. Today, we're diving into one of the most critical aspects of advanced investing: valuation. Accurately valuing companies is essential for identifying great investment opportunities and making informed decisions. Let's explore how to approach valuation with precision and look at some real-world examples to illustrate these concepts. Valuation is all about determining a company's intrinsic value, the true worth based on its fundamentals, rather than its current market price. The market can often misprice stocks due to sentiment and speculation, creating opportunities for those who can accurately assess a company's value. One of the most reliable methods for estimating intrinsic value is the discounted cash flow analysis. This method involves projecting a company's future cash flows and discounting them back to their present value using an appropriate discount rate. The result provides a solid foundation for understanding whether a stock is trading at a fair price. For instance, let's consider Apple. To apply DCF analysis, you would start by forecasting Apple's future cash flows over the next decade. This involves analyzing factors like revenue growth, profit margins, and capital expenditures. Next, you discount these projected cash flows back to their present value using a discount rate that reflects Apple's risk profile. The resulting figure helps determine if Apple's stock is undervalued or overvalued compared to its current market price. Another crucial method for valuation is the price-to-earnings (PE) ratio, which compares a company's current share price to its earnings per share. While the PE ratio offers a quick snapshot of valuation, it's important to use it in conjunction with other metrics. For example, consider a company like Amazon, which historically has had a high PE ratio. This high valuation is often justified by its robust growth prospects and market dominance. However, a high PE ratio alone doesn't guarantee a good investment. It's essential to understand the reasons behind the valuation and how sustainable the company's growth is. Additionally, the price-to-book (PB) ratio can provide insights into a company's valuation by comparing its market value to its book value. This is particularly useful for assessing asset-heavy companies. For instance, if a company like IBM is trading at a low PB ratio, it might indicate that the stock is undervalued relative to its assets. However, if the company's book value is declining, this could be a red flag, so it's important to analyze the broader context. The free cash flow (FCF) analysis is another valuable tool, focusing on the cash a company generates after accounting for capital expenditures. A company with strong, consistent free cash flow is often in a better position to return capital to shareholders or invest in growth opportunities. For example, Microsoft has demonstrated impressive free cash flow generation, which supports its high valuation and consistent dividend payments. Lastly, it's important to consider macroeconomic factors and industry conditions when valuing a company. For instance, during periods of economic uncertainty or rising interest rates, even fundamentally strong companies may experience valuation pressures. Being aware of these external factors can help you make more informed decisions and adjust your valuation models accordingly. In summary, advanced valuation involves a thorough analysis of a company's financials, understanding the methods like DCF, PE, PB, and FCF, and contextualizing these metrics within broader economic and industry trends. By mastering these techniques, you can better identify undervalued opportunities and make more strategic investment choices. Thanks for watching, and if you found this deep dive on valuation valuable, make sure to subscribe to Invest Avenue for more insights and advanced investment strategies. See you next time.